2025 is the year you could transform your financial future, or completely wreck it. The difference? Avoiding these 5 mistakes that countless investors make. If you're serious about building wealth, buckle up. This isn't just a list. It's your playbook for success in 2025. Ever wonder why some people seem to hit jackpot investments while others lose their shirt? Let's find out together. Starting with the one mistake that even smart investors make. Every single year. Alright, let's talk about the first mistake that's practically hardwired into our brains, blindly following the herd. It's tempting, right? When everyone's hyping up the next hot stock or must-buy crypto, that FOMO kicks in. You're scared you'll miss out on the rocket ship to riches, but here's the truth, and you gotta hear me on this. By the time everyone's talking about it, the big gains, they're gone. It's like showing up to a party after the cops have already shut it down. Think of it like a concert. If you're hearing about the tickets on the day of the show, congrats. You just scored a seat behind a pillar. The people who got in early, who did their research and made the move before it was trending, they're the ones stage diving right now. So how do you avoid this trap? It's simpler than you think. Focus on research, not rumors. Don't let hype dictate your investment decisions. Dig into the fundamentals, understand the company, the technology, the market. Because remember, you're not investing in a trending hashtag, you're investing in your future. And your future deserves more than just following the crowd. But what if I told you there's an even bigger, sneakier mistake hiding in plain sight? One that could completely derail your financial plans even if you think you're being smart. Let's talk about that. This next mistake is a classic, and it's one that even experienced investors can fall prey to, putting all your eggs in one basket. It feels bold, maybe even smart, to bet big on one thing. After all, the bigger the risk, the bigger the reward, right? This mindset can be incredibly tempting, especially when you see others making quick gains. But here's the harsh reality. What happens if that one thing crashes? The market is unpredictable and no one can foresee every twist and turn. Your dream investment can become your worst nightmare overnight. The emotional and financial toll can be devastating. Imagine sinking your savings into one tech stock that seems unstoppable. The allure of high returns can cloud your judgment. The hype is real, the charts are pointing to the moon, and then, the CEO tweets something outrageous, and boom, 50% of your money disappears, just like that. It's a stark reminder of how volatile the market can be. Diversification isn't about being boring, it's about survival. It's a strategy that helps you weather the storms of the market. It's about protecting yourself from the unexpected. Think of it as a financial safety net. It's like having multiple streams of income. If one dries up, you've got others to keep you afloat. This approach ensures that you're not overly reliant on a single source. But here's the real kicker. Most people mess this up without even realizing it. They think they're diversified because they own stocks in different companies. They think they're diversified because they own stocks in different companies. But what if all those companies are in the same industry? This is a common pitfall that can lead to significant losses. Or worse, what if they're all susceptible to the same economic factors? A downturn in that sector could wipe out your entire portfolio. True diversification means spreading your investments across different asset classes, stocks, bonds, real estate, you name it. This way, you're not putting all your eggs in one basket. It means thinking long-term and not putting all your faith in one single investment, no matter how promising it seems. It's about building a resilient portfolio, because remember, in the world of investing, nothing is guaranteed. The market can be unpredictable and unforgiving, and the only way to truly mitigate risk is to diversify. It's the cornerstone of a sound investment strategy. This next mistake is like a slow leak in your financial boat: hidden fees. They might seem small and insignificant at first, but over time, they can cause significant damage to your financial health. You don't see them, you don't feel them, until one day you're wondering why your portfolio isn't growing like it should. It's a silent drain on your investments, slowly eroding your potential gains. It's like ordering a fancy meal, only to realize you've been charged for the plate, the chair, and the air conditioning. These hidden costs can add up quickly, leaving you with less than you expected. Nobody's got time for that. We're talking about those sneaky expense ratios on mutual funds, those little percentages that seem harmless but can take a big bite out of your returns. We're talking about those sneaky expense ratios on mutual funds, those trading commissions that eat into your profits every time you buy or sell A small fee is deducted, and over time these can add up to a substantial amount. And those account maintenance fees that seem small but add up over time. These are the fees you pay just to keep your account open, and they can slowly drain your resources. Think about it this way: every dollar you pay in fees is a dollar that's not working for you. It's a dollar that's not being invested, not earning interest, and not growing your wealth. These fees might seem insignificant in the short term, but trust me, over the long haul, they can make a huge difference in your overall returns. The impact of these fees compounds over time, reducing your potential gains significantly. It's a dollar that's not compounding and growing your wealth. Instead, it's being siphoned off, little by little, reducing the power of your investments. It's like paying rent on your own money. You're essentially giving away a portion of your hard-earned cash for nothing in return. So what can you do about it? First, get educated. Knowledge is your best defense against these hidden fees. First, get educated. Understand the fees associated with different investment products and platforms. Take the time to read the fine print and know exactly what you're being charged for. Don't be afraid to ask questions and shop around for the most cost-effective options. There are plenty of low-cost investment options available if you take the time to look. Remember, knowledge is power, and when it comes to your finances, you want to be in the driver's seat. Take control and make informed decisions to protect your wealth. Don't let hidden fees sabotage your financial future. Be vigilant and proactive in managing your investments. Be proactive, be informed, and watch those fees like a hawk. Keep a close eye on your investments, and make sure you're not losing money to unnecessary fees. But fees aren't the only sneaky threat to your wealth. There's another, and this one's all about timing. One mistake that could cost you more than just money. Stay tuned to learn more about how timing can impact your financial success. Trying to time the market is mistake number 4, and let me be real. No one, not even Wall Street pros with their fancy algorithms and Bloomberg terminals, can predict every twist and turn of the market. Sure, you might get lucky once, maybe twice, but long-term success? That's not about gambling, it's about consistency. Timing the market is like trying to guess when your favorite Netflix series drops the new season. Spoiler alert, you're probably wrong. And in the time you spent refreshing Twitter for updates, you could have been, actually enjoying the previous seasons. Look, the market is driven by emotions, by news cycles, by a million different factors that are impossible to predict with 100% accuracy. And even if you guess the direction right, you still need to get the timing perfect. You need to buy at the absolute bottom and sell at the absolute top. Tell me, how many times have you done that? Instead of trying to be a fortune teller, focus on what you can control, your investment strategy. Choose quality investments, diversify your portfolio, and stay the course. Remember, time in the market is more important than timing the market, so if timing isn't the answer, what is? That brings me to the final mistake, one that stops people from even starting. This last mistake is a silent killer of dreams. It's the kind of mistake that sneaks up on you, whispering doubts and fears into your ear. It's the voice in your head that says, I'll start investing when the market is less volatile, when the news isn't so scary, or when the economy is more stable, or maybe it's when I have more money saved up, when I get that raise, or when my debts are paid off. Or perhaps it's when I understand everything perfectly, when I've read all the books, taken all the courses, and feel completely confident. Newsflash, there's no perfect moment to start investing, only lost opportunities the longer you wait. Time is your most valuable asset, and it's slipping away. Think about this. Every day you're out of the market is a day your money could have been working for you. It's like planting a tree. The best time was yesterday, the next best time is today. It's like leaving your car idling in the driveway. You're burning fuel, but you're not getting anywhere. Your money is losing potential growth every moment it sits idle. The sooner you start, the sooner you see the power of compound growth, and trust me, it's life-changing. It's the secret sauce of wealth building. Compound growth is like a snowball rolling downhill. It starts small, almost unnoticeable, but over time it picks up speed and size, becoming an unstoppable force. The longer it rolls, the bigger it gets. So, how do you overcome this paralysis by analysis? Simple. Start small. Take that first step, no matter how tiny it seems. You don't need a ton of money to get started. Even a modest amount can set the wheels in motion. Start with what you can afford, even if it's just a small amount each month. Consistency is key. The important thing is to start building the habit, to make investing a regular part of your life. The habit of investing is like nurturing a plant. It needs regular attention and care to grow. Get comfortable with the process. Use tools and resources to help you stay on track and make informed decisions. Remember, investing is a marathon, not a sprint. It's about long-term growth and endurance, and the sooner you start, the further ahead you'll be when it really counts. Every step you take now brings you closer to your financial goals. So, let's recap: avoid the herd, diversify your portfolio, watch those sneaky fees, stop timing the market, and for the love of your future self, start now. Don't wait for the perfect moment, create it. These 5 mistakes aren't just pitfalls, they're roadblocks that can derail your financial journey. They're the difference between struggling and thriving in 2025. Make the right choices today for a prosperous tomorrow. Look, I get it, investing can seem complicated, overwhelming even, but it doesn't have to be. By avoiding these 5 common mistakes, you're already miles ahead of the game. But here's the thing, investing is just one piece of the puzzle. If you want to build true wealth, you need multiple income streams. You need to diversify your income just like you diversify your investments. Want to know how to create them? Click on this video right here. It's packed with actionable strategies to take your finances to the next level. Don't just dream it, build it. See you there.